Americans have been facing rapidly increasing prices just about everywhere, from gas to groceries to housing. President Biden is expected to address all of this during a meeting with Federal Reserve Chairman Jerome Powell later on today. And this comes as early morning trading took a bit of a dip after rallying at the end of last week. So for more on all of this, we want to bring in Stacy, Director of Strategy at Optimal Capital. She's been analyzing the market for over a decade, and we love talking to you because you just bring it on down. You talk in regular people's language, and that's what I like. So President Biden published an op-ed yesterday in the Wall Street Journal, and in it he talked about his approach to inflation as well as the factors causing Americans to see, an increase in prices. And I think it's such an interesting time because the factors contributing to the price that we're paying, the factors are so varied. So, what can be attributed to the war in Ukraine versus other factors like the COVID stimulus plan, supply chain issues? Can you sort of break down how all of this is leading to inflation?
Yeah, I think it's causation versus correlation, right? That was a big discussion in the Amber Heard and Johnny Depp trial last week. The definition of inflation, one of the simpler definitions of inflation is the amount of money in circulation in ratio to the goods and services. So what you had with COVID was you piled on the money, right? Because we wanted to keep markets liquid, we wanted to keep the economy going, but because of COVID, the production of goods and services actually fell. So that ratio got very exacerbated, probably, at the fastest rate in history, probably not the amount in history, but at the fastest rate in history. And so that's what we're contending with. So when you look at what the Federal Reserve is trying to do, basically they're trying to pull money back out of circulation. How are they doing that? They're raising interest rates, which means they're disincentivizing new lending. The other thing that they're doing, and it starts on Wednesday, is they're reducing the assets on their balance sheet. So they're reducing the money supply, and we're trying to get supply chains, which were, the supply chain constraints from the lack of goods and services. We're trying to get supply chain constraints, fixed to a tolerable level. We don't know how the China lockdowns are going to affect that just yet. And so a lot of what Biden is talking about in this article is dealing with supply chain type issues and dealing with Congress and dealing with this kind of issue. The thing is what's the causation versus the correlation? Really, the Fed is in the driver's seat right now. And it's interesting to see Jerome Powell meeting with Joe Biden today because you've just got to reduce that money supply, and they really can't control the supply chain constraints. And so it's all about creating demand destruction in the background. And look, the economists are now starting to talk about peak inflation. I was probably too early on this, but you've got things in the background. You've got soy and corn and, even oil hasn't taken out the war high. And you've got, cattle and hogs, and some of these prices are starting to break down in the background. Fertilizer. It's just that there's such a lag effect. And so that's the thing, is they can't do it tomorrow.
We know that the president has sort of limited influence when it comes to inflation. Like you said, it's about the Fed. Is the Fed partially to blame? Because they sort of took their time when it came to raising interest rates.
I mean, I think that there was no model for COVID, right? And I think that was particularly tough. And the thing that, if you look at Jay Powell's career, Janet Yellen started tightening when they stopped the purchases on of assets on the balance sheet in the end of October of 14, and then raising rates in the end of 15. And what happened was when Jay Powell got into office, he had to pivot at the end of 2018 because the S&P 500 had sold off 20%. But what happened was actually in September of 19, that's how lagging these effects can be, right? What happened was they had a shortage of liquidity in the system when people went to sell things to make their corporate tax payments. And so he actually had to reignite, after reducing the balance sheet from that iteration of tightening, he actually had to reignite quantitative easing ahead of COVID. So that was his, inauguration, right? That was his initial experience. And so I think throughout the COVID phase, he recognized that there's a record amount of debt in the system. And so I think he was really reticent to start tightening that because of the lagging effects of liquidity concerns. So I have compassion for him. He's in a very tough spot. I do think that they're being very, very aggressive. However, we are slated to tighten as much as we did last time over a number of years in 1 year. And we do have that record amount of debt in the system. And so that leaves us without all of the time to recalibrate the system. And that increases the probability of a policy error. So he's really stuck with the criticism of not being aggressive initially. And now he's tightening into things that are slowing down, like those prices that I mentioned that for the time being have actually rolled over.
And now everyone's like, oh, I don't know, it might be too aggressive. It's going to be a bumpy ride. That's all I know. Frances, Stacy, thank you very much.
Thanks, Anne Marie. Good to see you.
Good to see you, too.